With the recent global and Australian market volatility, we thought it was appropriate to provide investors with an update with a focus on the Australian share market and the underlying fundamentals that we've seen through the recent reporting season. Before we move into that, I just thought I'd touch on the reasons that the offshore markets have been so volatile. And these have really centred around concerns in the US and concerns in Europe around political instability. I say political instability because ultimately we think that solutions are available to both the European crisis as well as issues that remain in the US. But the markets have become jittery as they've seen the political leaders sit on the sidelines and have question marks over whether they'll have the political will to solve some of these issues. These issues, namely in Europe, are to deal with the solvency concerns that exist in Greece, Ireland and Portugal, and the steps taken recently by the European central banks and residual governments to deal with these issues are a long step forward in terms of restructuring the debt that exists within these countries. However, these solvency issues have led to liquidity questions on peripheral countries, core countries like Italy and Spain. And Italy's come to the fore as bond investors have continued to step back and required higher and higher yields to finance the ongoing current account deficits which exist in Italy. This takes our focus as well to the US, where in late July, early August, the catalyst for the market volatility was basically Congress's inability to agree to an expedient increase in the debt ceiling. This led markets to actually start to question the political resolve to deal with some of the issues. The outcome of the increase to the debt ceiling was an agreed cut to the ongoing current account deficits in the country, and again markets then focused on the austerity measures and the impact of future economic growth this will have. As I mentioned earlier, we remain confident that both the European and US issues can be remedied, but there will be sustained volatility, we believe, as the political will to solve some of these issues continues to be tested. Whenever there's volatility like this in the market, the important thing to do is to focus on the underlying fundamentals of the investment. And these are often thrown out in the concerns over the turmoil. The recent Australian equity reporting season has provided us with a very, very strong view into what the underlying companies that we're investing in, how they're performing and what their outlooks are. Now, it's fair to say that given the recent reporting season actually occurred during this recent market volatility, there weren't a lot of CEOs who were willing to step up and give strong guidance in the future 12 months. But in our view, the market's already pricing in a 15% drop in future earnings to catch up with the price falls that already occurred. And in the portfolio of securities that we're currently holding, we can't actually see that occurring. Now, that doesn't mean that the market won't continue to be volatile and there can't be further falls to the underlying market, but all that means is that we'll have the opportunity to continue to buy great companies that are continuing to generate strong earnings growth at even cheaper prices. And one of the strong things that we get a lot of confidence on in these environments is the strength of the dividend yield coming through from a lot of our companies. One of the recent themes that came out of the reporting season is one that we've been talking about for some time now, and that's the strength or the dichotomy of the two-tier economy in Australia. The strength of the resource sector continues to be maintained, and that's what's driving the high terms of trade that Australia continues to enjoy. We believe, though, that the suffering that's felt in the discretionary part of the market, the consumer discretionary part, is also going to be maintained as monetary and fiscal policy in the country is going to continue to be set with a focus on these strong terms of trade. Now, ultimately, this is a sector of the economy that we've avoided in the portfolios, and we believe that it's going to continue to be under pressure for a sustained period of time. Across the portfolio, we're extremely happy with the quality of the results that we receive. If the first sector we look at is the resource sector, both BHP and Rio recorded record profits through the month. BHP's earnings increased by a staggering 40%, and this, coupled with the capital management initiatives that went on throughout the year, resulted in earnings per share increasing by greater than 80%. Now, on our estimates, BHP's on an earnings multiple of about 8 times going into full year 2012, and we're very, very comfortable that the stock is well placed. Ultimately, both BHP and Rio, though, are going to be driven in the short term by the macroeconomic concerns which sit over the global economy. And ultimately, a material slowdown in Europe will lead to, we expect must lead to, a softening in demand out of China in the short term. However, the other key thing that came out of the reporting season is the difficulty that these large resource companies are having in bringing new supply into market. BHP have a capital expenditure program of about $80 billion expected over the next 5 years, and in the full year, financial year to 2011, they expected to spend $15 billion of that, but they fell about 20% short and only spent a little over $12 billion. Now, the reasons provided to this were the obvious constraints in supply as well as resource capacity to make these expansions. But ultimately, we feel very comfortable that the ongoing supply that is increasing into the market is still going to undershoot the demand increases that are expected in the next 2, 3, 4 years. As we've spoken about before, it's inevitable that that supply will meet and then exceed the demand, but we still feel comfortable that this is many, many years down the track. As a side note, this does have clear implications for the Australian terms of trade on a 5-year plus outlook, given that supply, as I mentioned, will exceed that long-term demand coming out of China. One of the other sectors of the portfolio I wanted to spend a bit of time talking about today is the infrastructure sector. Now, in the context of global volatility and trying to express today the earnings certainty that we're trying to find in securities, nothing probably articulates that better than some of our investments in infrastructure stocks. Transurban, which is an urban toll road that owns CityLink down in Melbourne, as well as a number of interurban toll roads up in Sydney, is a very, very good example of that. Now, Transurban basically, like a lot of these toll roads, have concessions that allow them to increase their tolls at a certain amount every year, basically around CPI plus or minus. So Transurban's toll roads in Australia allowed them to increase their tolls by a little over 3% during the year. In addition to that, they had toll or traffic increases of about 6%. Collectively, it resulted in revenue growth of over 10%. Now, the beauty of toll roads is with an extra 10% of revenue being generated, or an extra 6% of cars going down the road, you need almost zero additional cost to achieve that. So earnings grew by 17%. Now, one of the things about these roads is, irrespective of economic conditions, people continue to use toll roads on a daily basis to get to work and for their daily functioning. So they show very, very strong resilience to fluctuations in economic activities. And ultimately, whilst the share price may go up and down on a daily basis, at the end of the day, investors have got a 17% increase in their underlying earnings. And we expect those numbers to continue for many, many years on these roads as they're yet to reach maturity. Now, ultimately, that drives dividend growth, which ultimately is got to be a true reflection of share price over time. Another good example of that is Connect East, Australian Infrastructure Fund, being two other infrastructure investments, and Queensland Rail, which was a privatised Queensland Rail asset that came into the portfolio at the end of last year. Queensland Rail handed down its first full year results in August, and I thought they were nothing short of exceptional. The company continues to take out very, very strong cost cutting, and in addition to that was heavily affected by the Queensland floods in January and February of this year, which continues to impact the company as many of the coal mines that it hauls coals from continue to be impacted by the elevated levels of water within the mines. But ultimately, these are short-term events, and the company continues to be very, very well placed to continue to drive double-digit earnings growth for the foreseeable future. In addition to the resource sector, the probably other largest sector in the portfolio, and one that gets a lot of attention in the media, is the banking sector. And again, we think that the banking sector concerns are materially overdone. There's absolutely no question that if issues within Europe maintained, that the banking sector is going to continue to be, from a share price perspective, under pressure. However, we remain very, very comfortable with the quality of the Australian banking franchises. The Australian banking industry is very distinct compared to offshore banking industries. Ultimately, we have a very stable oligopoly with the leading 4 banks dominating the industry here, which is in complete contrast to the highly competitive industry that exists in the US and Europe. As a result of that, the banks have been able to achieve much higher margins and much higher returns on their assets or on their equity than offshore counterparts. And this has resulted in them continuing to have much stronger balance sheets than exist offshore. Ultimately, the strength of these franchises means that any inherent increases that they receive from offshore funding increases, basically through European debt concerns, will be passed through to us as the consumers. And this is again the strength of their franchise. And we've seen that recently with the results that came through showing that their net interest margin, which is the difference between the money that they borrow and the money they lend, again continuing to increase incrementally. Costs remain under control and we remain comfortable with the asset quality or the level of bad debts on their books. Now, one thing you can be sure of is the Australian banking industry will not continue to grow at rates that we've seen in the last decade, with credit growth remaining subdued. However, at the current levels with dividend yields between 7 and 8% fully franked, so grossed up yields in excess of 10%, we remain comfortable that many of these risks are already materially priced into the Australian share prices. So in summary, we remain very comfortable with the current investments in the portfolio, the quality of the businesses and the sustainability of earnings moving forward. One of the things that has come to the fore in recent months though, and this is really as a result of the economic weakness out of the US, is the US interest rate policy has been set to close to zero. Now we actually think that this is going to have a material implication for the ongoing strength of the Australian dollar. The Australian dollar is currently trading about 106 cents to the US dollar, so trading above parity. And in the Australian mindset, this is considered as expensive. But with the US government that's continuing to print US dollars in order to inflate the US economy, as well as have a committed interest rate policy that's close to zero, then we've started to become aware that the continuing appreciation of the Australian dollar is a real potential. Now, needless to say that the Australian dollar is also considered a risk asset in a global context. So if risk is continued to be repriced into the global marketplace, you will see the Australian dollar fall and potentially fall precipitously. But on a medium-term outlook, we have started to do some further work around the prospect of the Australian dollar continuing to appreciate from its current levels for a continued period of time.